SandRidge gets a downgrade to 0. Dan, can this actually go to 0? Yes, the company has assets, but severely over-levered. How does an analyst go to a 0 price target?
It's very simple. I mean, you run out of cash. I mean, that's really simple. You pump, and you can't pump at a break-even price anymore, and every barrel that you pull out is a loser. I mean, that's really how it goes. And then you have a very over-leveraged bond position that you need to obviously satisfy every month, and you run out of cash, hence bankruptcy. I mean, it's something that I've said is very, very possible for a lot of shale players out there, and I think that SandRidge is only the first of what will be several, if not bankruptcies, the kinds of restructurings that kind of indicate that otherwise they would have gone bankrupt. You had for example, a very under pressure secondary from Oasis today of $400 million. Now that's a desperation kind of play but it was fully subscribed, and it puts the timeline on someone like Oasis further down the line before they have to do some major selling of assets or a major restructuring.
Who's next?
Yeah, I think you look at the bond numbers. If you look at the bonds, the underlying bonds, they give you an indication of just how serious the default risk is, and someone like Halcon, for example, is a serious default risk. Their bonds are going upwards of 16%. It's CCC paper. Someone like American Eagle, I mean, bonds selling at 39 cents on the dollar.
Right.
This is trouble. Emerald Oil. These very, very small cap players are going to follow SandRidge basically to 0 or close to.
So what happens when they dissolve? What happens to those assets?
The assets go back to the banks. I mean, that's what happens. The banks get them, and they don't know what to do with them, and then there's a whole, obviously a sale of assets to somebody at pennies on the dollar, but in the end, the company itself is gone.
It seems like leverage and flexibility are more important than ever.
That's exactly right. I think you really hit it on the head. So when we're looking at these and we're trying to find some winners as well as losers, we're looking for those that have flexibility, and that means that they have ability to produce or not produce to a certain degree, and they have certain areas, core areas, that they can reach to produce, and not all of them are these kinds of inflexible and not profitable areas like some of these others, like Halcon. Goodrich is another one, clearly has a problem. And these are the ones that we got to look for, and that are going to make it through this. And the weak ones, like SandRidge, like Goodrich, like American Eagle, like Emerald, like a few others I could name. These are the ones that are not.
So if you don't like the stock, you don't want to be involved in the equity, are there any bond positions you might look at? Because some of the assets are okay.
The way to look at a bond position in some of these is to pray that somebody comes in a sale and buys up an asset, buys something out at a fire sale price, and looks to make the bonds good or the bondholders good as part of a buyout package. So in that regard, I can understand why someone like Halcon is still trading cheaply at 70 cents on the dollar. To me, that's cheaply, even though it's incredibly underpriced. But that is what you're playing for. I do not believe that oil will recover fast enough, even under the best case scenario, to save these companies as they stand right now. Something needs to be restructured, reorganized, lots of assets sold, new financing, buyouts. Something's got to happen.
Okay, thanks very much, Dan. For The Street in New York, I'm Jill Malandrino.